We're going to be covering fixed income funds in this video. Fixed income funds are those that invest in bonds issued by governments or companies. Fixed income funds tend to have a much lower risk level, lower returns, and volatility, and that makes these funds much safer than equity funds. These funds are a must in your portfolio so that you have stability in your portfolio. When we covered asset allocation, we looked at how your fixed income allocation must increase over time so that your portfolio ends up being more stable as you get older, and you'll reduce the chance of losing money. And that's purely because fixed income funds are much safer. Fixed income funds can also be chosen for shorter duration investments. When we looked at equity funds, we saw that equity funds should be held for at least 5 years, and holding that for a period of less than 5 years can end up in a loss. So if I was to buy a car in 3 years, I would not want to hold any equity funds because then I just might not be able to buy that car. However, I would put that money into fixed income funds so that the chances of me losing money are much lower and I'm more sure of attaining my objective. Funds can be selected based on duration, which is the holding period of the fund. So if I want to put money in for 4 years, I'm going to look for a fund whose duration is in the range of 4 years. I'm going to look at the risk levels of the fund, and I'm going to look at the yield to maturity. Yield to maturity can be defined as the gain expected in the fund based on the securities that have been bought into the fund and looking at the prices those securities were bought at. The lower the purchase price of the bonds, the higher the yield to maturity. Government securities tend to give you the lowest return, and that's because they normally have the lowest risk. We always assume that governments are going to be able to pay back the money in time, and so we assume that they are going to be the safest investments available and thus the lowest return. Comparable corporate bond securities will give you a better return but will also take on more risk. The lower the rating of the bonds in the fund, the higher the risk. The ratings are given by ratings agencies such as CRISIL or ICRA. Um, these ratings agencies are independent bodies that assess the financial health of the company that is issuing the bonds and also the particular bond offering. And a rating is assigned to help the investors, or in this case the funds, determine the quality of the investment. Every agency has a different rating scales, but they're kind of generally AAA to D for longer tenure bonds and A to E for shorter tenure bonds. Government securities are given a rating of sovereign, and this is the highest rating possible because, as we looked at earlier, we expect governments to pay back the money on time. Risk can also be addressed by looking at the ratings in a fund. The higher the percentage of AAA investments, the safer the fund. If we look at fixed income funds from a taxation perspective, any fund that holds more than 65% of its assets in fixed income is considered a fixed income oriented fund, and income tax rates would need to be paid on the gain. This makes the fund unattractive, but they are a must for your portfolio to help bring stability to your investments. Some allocation should be made to fixed income funds even when starting your investment process. I hope you enjoyed this video. Do reach out to me at the email address and the mobile number provided. Please do check out my website, which is www.aditshah.in. Links to my social media handles are available there. Please do follow me. Thanks for taking the time to watch this video. Take care.